We're rolling right now? The whole time? You said it, right? Yeah. Hey guys, what's going on? It's David Ralic here with Society. I asked my friend Pat Delaney, who was born underwriting mortgages, to come over and talk to us today about why the rates are fluctuating the way they do. We hear Fed rate go up, I see rates come down, and it doesn't make any sense to me. So today, the man, the myth, the legend, Pat Delaney, is going to talk to us today how it all works. So Pat, tell me, what the hell is going on? Why do the rates go up?
I have no idea.
Okay, cool. That's all, folks. Thank you so much for checking out their video today.
First and foremost, thanks for having me here. I appreciate everybody's time. And yeah, this is a pretty wild time, right? Fed raises the federal fund rate by 0.75 of a point, and we saw interest rates that 3 weeks ago, I thought were going to be close to 7%, right? We were creeping up around that 6.25 range, and everybody was terrified of this federal rate increase. Was it going to be a half, 3/4, a full point? The full point would have been unprecedented. They did 3/4, and we've actually seen a drop in interest rate, right?
So can you elaborate? So like the Fed's raising the rates to hedge inflation, correct, to slow things down so we come to some kind of like normalcy.
Maybe an equilibrium somewhere.
Right. So the Fed's raise, activity starts to die down, buyer pool dries up, people are a little more, they create smoke and mirrors, but actually the rate got stronger with the raise. How does that? It doesn't make sense to a guy like me. I'm more eye candy than brains.
Oh no, you're both. Believe me. Yeah, it's an interesting thing. So you would think that when the Fed raises interest rates, and what they're doing when the Fed raises its federal funds rate, it's basically increasing the cost of borrowing money for not just consumers, but more importantly, banks to borrow from other banks. The overnight lending rate increases. Pretty complicated stuff, right? However, mortgage rates follow mortgage-backed securities, and they follow Treasury indexes, mostly the 10-year Treasury.
So Treasury index versus Fed are kind of two different animals?
Two different animals.
Oh, wow. I didn't know this. But I don't know if you guys knew this stuff, but I just learned this just now. Mind-blowing. There's a Treasury index versus the federal rates that are set by the Fed are actually two different animals. And that's so the Treasury index is what not controls,
but mortgages follow three. Well, obviously the federal interaction, that's an issue, right? And then there's a 10-year Treasury index, which most 30-year interest rates will tend to follow. There's also mortgage-backed securities. Every time a mortgage is created, it creates a mortgage-backed security that gets bought and sold through Fannie Mae, Freddie Mac. Everybody's heard of Fannie. Everybody's heard of Freddie, right? These rates have to follow something. Now, we talk about equilibrium. We talk about inflation and what pushes things up. And some of the things I like to think about, what's good for interest rate and what is bad for interest rate. Bad news is always good for interest rates. Right, people are out of work. Yeah, I'm really.
Does anyone scratch their head on this? Bad news.
Bad news is good
for
sure, right? Because when you think about the Treasury indexes and what gets sold and what gets bought, when there's bad news, people don't spend money, right? Everybody wants to save their money. They want to, hide in a corner, right? So they invest in United States Treasury indexes. So what does the government do? Well, they lower that, or they lower that index, right? So they don't have to pay as much for that. Okay. When there's good news, people don't invest in Treasury indexes. So what the government has to do is increase that yield that they're willing to pay. So people will, private equity groups, you and I buying U.S. Treasury bonds, they have to increase what they pay out on those things. The government is the largest buyer, and I think I was talking to Rowan about this, the largest buyer of liquidity in the mortgage-backed market right now. And they have been since probably 2000, 1999, 2000.
Wow.
Yeah. So everything is driven by either supply and demand, right? When people need money, the rates go up. That's an easy one. Inflation rates go up, right? That's a different category. So there's multiple different categories that do this. So let's talk about supply and demand right now. That's the first one we'll talk about. Everybody's trying to buy houses. The price of houses has gone through the roof. At the same time, we get hit with this massive inflation that we haven't seen in, what did they say, 40 years?
Something like that, yeah, since the 80s.
Yeah, like since Ford, Carter, that time. Right, so the federal government's only way to control inflation is to increase the cost of borrowing money. that
So
drive.
I don't know about how, like, trying to understand from a layman's perspective, we're doing really good. They want to punish the good. Not to sound like, it's not meant to be like, so everyone's doing really well. Things are getting more expensive, so they go and undercut the capitalism. You got to slow it down. Right. Why do you have to slow it down?
Well, you see what you see right now in the marketplace. If you don't slow it down, home prices go through the roof like they've done. People's income does not keep up with the growth in purchase price of these houses. It gets more and more difficult for people to buy homes. Right?
So that's a great segue, too, because I understand it, how you taught me a while back was people can't buy houses based on the number of the house. They buy houses based on the debt to income ratios on a house. I feel like no one ever talks about, they talk about a rate, they talk about a purchase price, but they don't really explain what DTI means to people, right, and how somebody with a higher credit score, less debt, can buy with the same salary, same monthly income, could buy a different level of house than someone who might be making $100,000 a year, but they have 7 cars, 2 boats, and credit card debt out the wazoo.
Or the biggest problem, $150,000 in student loan debt.
Oh, right? There goes
There's another factor that comes into all of this thing. So when we talk about interest rates in the home buying process is one particular factor, right? There's a lot of them. It's what people can afford. I try to change the narrative in this process from just, hey, what's your interest rate today? Because it's, it could be whatever I tell you it is. Today the market, let's put the market at 5 3/8 on a 30-year fixed mortgage.
Just do quarters, right? It's 3/8 stuff.
All right, yeah. All right, round up. Let's do 5.5
that way. I'm not that smart.
Let's do 5.5. But okay. To your point, somebody who makes $100,000 a year, who has a $300 car payment, and maybe $200 in student loans, can afford a lot more to somebody who might, let's say, be a single parent who's got 2 children in daycare and has to pay for daycare expenses, and has a larger car payment and student loan debt. So it all ties together. It's not just interest rate, which is why the narrative, when you take somebody through the home buying process, really has to go beyond what is your interest rate.
And this is a reason, guys, why you need to call him if you're going to get a mortgage, you want to work with somebody who's smart. Everyone could go push paper, but you want somebody who's like super smart on how to make sure it all works together. So Pat Delaney at Union Home Mortgage, I'm going to plug him again because
thanks, great stuff. I'll take the plug.
Continue, please.
It's all good.
Drop knowledge bombs.
I'll take questions as you got in the first few minutes. We hit so many different topics. So if you have any questions, just start on them. But, the 10-year Treasury Index, again, it jumps up a lot, right? It jumped up and it followed the Fed raising of interest rates. But then you've got supply versus demand. Every week there is a list of reports that come out. The consumer price index, unemployment reports. Thursdays and Fridays, just for the record, are extremely volatile in the mortgage world. You know why? Because all the either really good news comes out or all the really bad news comes out.
And bad is good.
Bad is good.
That is good.
For interest rates. Right?
For interest rates. There you go.
Good is bad, right? Because good means the economy is doing extremely well, and which means we have to slow it down.
You got to keep it in check.
We got to keep it in check. So there's a lot of different things that go into it. And then there's the third factor. We've talked about good and we've talked about bad. And then there's the what if nothing happens?
Stagflation?
No, that's different. That's a whole other animal. There's stockbrokers, there's bond traders, right? The only people who really make money, I don't want to say that everybody makes money, but everybody gets paid a commission when a trade goes through, right? Well, if no trades are going through, that means nobody's really making any money. So you've got a lot of things that impact interest rate. You've got reality, and then you've got what's kind of like arbitrary. It's like perception. What is really good news? What is really bad news? I have a website that is called Mortgage-Backed Securities Live. It gives you every week a list of all these reports that are coming out. It gives you a list of what the anticipated numbers are going to be, as far unemployment claims. They'll say 360,000 people this week are scheduled to file for unemployment claims. Well, if only 345 file, well, that means things are good, right? So, we got issues, right? If 395 file, that means 50,000 more people are out of work, and that's good for interest rates, for lack of a better word.
So if you're ever trying to pace your interest rate, you should start looking at employment job reportings and Wall Street.
You don't want to be
you don't want to be neurotic.
What I would encourage a real estate agent or a real estate company to do is to try and change the narrative around interest rates, right? Around the process. Interest rates are important, but really what is important is the payment, right? You don't pay an interest rate every month. You make a monthly mortgage payment. And a lot of times people can afford a lot more. I can qualify people for a lot more than they're really comfortable paying. So as agents, you want to be as involved in the process as you're comfortable being. But what you don't want to be is the expert, because at the end of the day, nobody really knows what interest rates are going to do on any given day, right? That's why I'll give you an example. I think I used the Wag the Dog. It was a great movie, right? It was like from 1997, and I think in the movie the president got caught doing something he shouldn't be doing.
The homage to Bill Clinton.
Yeah, right. He got caught doing something he shouldn't be doing.
Started a war
so he started a fake war, right? To just just to take the eyes off of him, they created an actual war on paper, movie sets, the whole thing, and it's a little bit of a dark comedy about what really could happen. Bad things always happen on the weekends, right? Rates are volatile on Friday because most of the time, if there is some kind of I'll give you an example. If we have to, after 9/11, I remember I'm pretty sure we started our invasion over the weekend or late on a Friday night. There's a reason for that. It gives the markets 48 hours to digest that bad news, right? So it gives everybody the weekend to calm down. So when Monday morning opens up, it's not as hairy.
I don't know about you guys, but I'm like totally mind blown that I didn't think that. Hey, let's invade the country on a Friday because we can let
it lets the markets digest it. It lets the market. If you did it on a Tuesday night, the markets would go nuts Wednesday morning, and you could end up with a halt in trading. It's just you got to give time for all that stuff. There's so much that goes into this. But what are we seeing right now? We're seeing an awful lot of inflation. And everything is lagging. So we've just seen gas prices come down, about 80 cents in the last month, probably. So that's going to take a lot of time. All the reports that come out, the inflation reports are lagging. So something that happens today might not impact that report for a month or two. So you're always caught in between of good things and where the interest rates are. So the logic behind, somebody said to me the other day, well, if interest rates keep going up, the price of houses have to come down, right? That makes sense, right? Because people can't afford to pay to pay the higher price. The problem is there's that lag period, right? Where let's say the rates did go to 7%.
Which we're not saying it's going to.
We're not saying it's going to. But I'll give you an example. I had a person that I had pre-qualified 3 months ago for $425,000, right? 2.5 months later, their buying power is down to $275,000. That 250 basis point jump that we saw in interest rate was a really, really huge problem for them. Now take it a step further. Let's say they're going, okay, well then we'll just wait and we'll wait for the prices of houses to come back down. One, they're competing with people that can still afford those prices. And two, even if nobody could afford it, it would still take probably 3 months for the people selling the house to go, hey, wait, we're not selling it because we're overpriced. And then they would get with your agent and say, hey, let's drop the house. So there's like a 4 or 5 month lag between what affects interest rates and what affects prices. And in my opinion, that's kind of where we are right now. Like when I look on realtor.com, obviously I'm not as busy as I'd like to be. I spend a lot of time with my clients. And when I know somebody's looking for a house, I spend time on realtor.com. I look for things for them. And, I start to see more houses on the market right now. And I'm starting to see, the little red arrow down that like prices are coming off a little bit, which I personally think is good for the market. We're going to see some folks, be able to afford a little bit more. And, more houses will mean more offers get accepted.
So as far as volume of mortgage applications, I know obviously knee-jerk reaction to the initial movements from the Fed was like everybody got scared. Everybody pulled back. They said, oh, shit, let's not buy. Now, obviously, rates have come down a little bit. So are buyers kind of like creeping back in? They're accepting the like, hey, it's not 7, it's 5, 7.5, whatever. Are the buyers, are you seeing the application influx over the past month in the greater Philadelphia area?
No. To answer your question, not just yet. Now, what I will tell you is this. There are pockets of time where we see these real quick drops. Like there was one particular day for about 3 hours where interest rates actually got down to about 5% this week. Now, in the utopic world, I would call every single person that I know looking for a house and say, hey, you should utilize our lock and shop program. That's a plug for Lock and Shop. Somebody asked me what Lock and Shop is.
What is Lock and Shop?
How long? Yeah.
Right, 90 days. The answer is
so you lock that low rate in 90 days.
I can take that without having a contract and say, I'll guarantee you this interest rate for 60 days, and then you have 30 days to close once you find a house. Right. So anybody who did that, and I had 2, right, they're now locked at the interest rate slightly higher than 5. It's 5 1/8. But let's say rates go back up to 6. That might make them a little bit more aggressive going after a house because they know they've got, they're in the money on an interest rate, right? They're
a point discount.
You got a point discount on interest rate. So to answer your question, it helped me this week because over the last 4 months, I had a lot of folks that we closed in that 5 3/4 to 6% range. And some of the loan amounts are larger, $500,000-$600,000. You bet if I called you up and said, "Hey, Mike, can I take you from 6%, down to 5 1/8, and it'll save you $300 a month? You want to jump on that?"
Can you touch on that a little bit deeper, please? Like buying power, right? So like at 600,000 or 700, like at what point? Because it's a subjective answer too.
Yeah.
Do you actually start to feel a difference in like when somebody says I'm shopping rates and I'm going to leave you and I'm going to go with the guy that offered me a 0.25% discount, 0.25% discount on my rate. When you're talking about a $200,000, $300,000 buyer, how do you quantify that? Like the average sales price, what, $250,000, $300,000 in our market, right? Like,
so
and they switch lender, right?
It's a little bit higher,
right? So okay, so like 300. Let's just use 300 as an arbitrary, and I say I'm going to go switch lenders for a 1/4 point. Is that like $3 a month? Is that like $20 a month?
You know what? I'll give you an example. I had one yesterday. $500,000. It's an eighth in interest rate was like $40-something a month.
At $500,000.
At $500,000, right? So drop that down to
cut it in half would be $80.
Exactly.
Yeah.
No, it'd be cheaper, less. So
gotcha.
So that happens, right? I mean that does happen a lot. You do get shopped that way, but at Union in particular, we are extremely customer centric. So you call me for a pre-qualification on a Saturday at 5 o'clock, I'm there, right? Everything we can do is right here from the phone. I can get pre-quals out as soon as you need them, as fast as you need them. Number one lender in the country right now, guess who? Anybody want to guess?
Quicken.
Union
Rocket. Right now. Rocket.
Quicken is Rocket.
Rocket, right. I always go by Rocket. But
okay.
So,
I go by Rocket too.
Rocket's very good, right? They're priced really well, but you need to close a deal on a Saturday afternoon.
Good luck.
Try getting your 800 number guy.
You're calling Detroit.
You're calling
1-800 number. You get a different person every time.
And they're very good. I'll tell you what they're very good at. They're very good up front on the point of sale, right? That sales guy stays with people, but they move from department to department through the transaction. So you might have 8 to 10 people as you go through that process, and inevitably, you're a week before closing or a day before closing, and you need somebody at a place like Union. You call me, and I get that done. Right? We make sure that happens. We do not miss closing dates.
Yeah, so like $20-$30 a month on a deal, and all of a sudden you think you got like a great deal, and you end up losing the house of your dreams over $20 a month because the other lender isn't able to respond to things.
And some people do that, right? Some people look at that and they don't see value in that, and they take that risk, and sometimes it pays off, and sometimes they get sometimes they get stung by it. Sometimes they get stung by it a little bit. But I would tell you, if you want to watch, you can watch all different kinds of financial news channels. You can watch Fox News. You can watch CNN News. You're going to get two different versions, right? You can go on any website right now and see doom and gloom. The world is falling. Interest rates are going to be 8%. Or you can see, if you go to the other channel, you could see, hey, our economic plan is actually working and gas prices are lowering and interest rates came down a full point this week and it's really not all that bad.
That's insane. I didn't realize that it went down a whole point in 1 week, and you would think like that would be some kind of like headline that you would see somewhere. Did anyone in this room hear about a whole point reduction of mortgage rates this week? Because
we did in the industry, but it wasn't national.
No, I was today years old when I found out about this.
You wouldn't have heard that this week. All you heard this week was
the end of the world.
All you heard this week was that the
Monkeypox.
Fed raised their interest rate by 3/4 of a point.
Wow.
Right? That's the only headline.
And that's why we asked you to be here today.
And going off that forecasting, a little bit of forecasting, we all know the Fed tells you what their plan is. We're going to raise it 75 basis points here. Dip into the crystal ball, forecast for us a little bit if you could. What do you see? Where do you see mortgage rates going in the immediate future and beyond?
I would like to say that there's going to be an equilibrium somewhere. I was talking to Roman about this yesterday, and I've been doing this a long time, right? So when I say to you, we live in a subsidized financial society right now. Anytime the federal government is the biggest investor in mortgage-backed securities, okay, that's a problem. That means there's no private equity that's buying this instrument. And without private industry coming in, and when I refer to private industry, I'm talking hedge funds. We're talking, big wealth management folks, right?
Yeah.
Pension funds. When they're not buying that stuff, if the federal government doesn't come in and buy it, you have no liquidity in the marketplace and you're not lending money. And that takes you back to places like in the 70s and 80s when you had to put 20% down to buy a house. Right. And the U.S. economy follows real estate. When real estate does well, generally speaking, the economy is doing well. So the reason I go down that road is that the Fed has wanted to exit this kind of subsidizing of our market for a very, very long time. Right. But they haven't been able to figure out how to do it. Raising interest rates will bring private equity back into this industry a little bit.
Because the juice is worth the squeeze now.
Yeah, exactly. Like if you're a hedge fund manager managing, a $50 billion hedge fund, maybe you do want some very safe, secure 30-year instrument at 5% to offset that, crazier investment that you think is going to pay you, 15%. That's way above my pay grade, like way above my pay grade. I just know that when the government is subsidizing it, it's bad for everybody. Now, in my age group, and I'm old, right? For this business, I'm old. I started selling mortgages when they were 14%.
So stop crying about your 5 and 6.
Well, that's my point, right? So for me, 5%, 6%, that's not so bad, right? I mean, it's, that's nothing. But in the younger age group, they see that rates aren't 3.5%, and I'm like, oh my God, 3.5%. Right. But let's look at the narrative. That same person who's going to say, oh, my God, I've got to pay 5% of the house for a house, which, by the way, is an appreciating asset and will help you in the long run, thinks nothing about going out and buying a $70,000 BMW at 6.9 or 7% for 5 years. Right. That's huge. It's a mindset. Appreciation, depreciation, your net worth, your equity, your whole 95. I think it's like 95% of wealth in this country is based on real estate. So if you think your BMW, that's a freaking boat anchor, the second you show up the lot, just
it's like cool, dude. Yeah,
just credit card
buy a
debt.
house.
People with credit card debt on the balance sheet, right? The credit cards, 22%, no problem. Let's go buy a TV.
Yeah,
right.
A $300 TV at that point. You're gonna pay that on interest.
But 6% on a mortgage is like, oh, I can't do this.
Yeah, I can't do this. It's crazy. Holy smokes, right? And it's tax deductible, and what 6% really isn't 6%, depending on what tax bracket you're in, right? If you're paying.
I recently read an article about this Gen Z, as that they're so mortgage illiterate. They have no idea. Per this article, again,
what is Gen Z, and when do we start over again?
Millennial, and then I think it's Gen Z.
Do we go back to Gen A?
So
double A. Gen A.
Kids in their 20s, right? So I think it's like basically kids in their 20s right now. They have no idea. They grew up. They came up through that that period during the collapse of '08, right?
Yeah.
Like they came through that period. They saw a lot of negative stuff, and to them, renting is great. But I think there needs to be a beacon of light to tell them, like, hey guys, like you're making all your money in crypto. You need to buy some real estate, leverage some mortgage instruments. So where can they find you? On what? Your website or?
Well, you can find me on my website. You can find me on my cell phone number, which is right behind me, 609-405-1567. You will get me pretty much any time. I want to mention one other thing, too, that we're seeing, which is an interesting thing in this market, which is why you might see some more houses on the sale. The last time we had this problem in 2007, 2008, 10% of the real estate market was owned by investors, so 90% of it was primary residences. I just read an article yesterday, something to the effect of like 22 or 23% of the real estate now
One out of every five.
is what's that?
1 out of every 5 is owned by an investor.
Right. So you might see more houses come on the market, and you might see values, start to drop a little bit, because for them, it's a business decision. We bought it at X, we're up 25%. Let's just dump it and take some money off the table. I think that could help the market.
From our fund perspective and from our investors, we're real estate brokerage, we have all that stuff, but we're really good at the fund modeling and cash flow, debt, private equity, stuff like that. My thought today is that we're actually never going to see those properties hit the market again. That massive funds that have hundreds of millions of dollars.
That's Dave and his company, by the way. They own 5% of South Jersey.
We just keep them, and we're going to keep it in cash flow perpetuity. It's an asset, a great vehicle, great instrument across the board systemically. So from that perspective, I will say I wouldn't hang my hat or have any kind of hopes or aspiration you'll ever see BlackRock or Blackstone or one of those companies ever sell their tranche back off. They'll trade it with each other to rewrite depreciation with each other. That's how they'll do the capital calls to it. But I doubt you'll ever see it come back to the retail market. There's a big movement in build to rent. And again, Gen Z, guys, I'm talking to you. You got to start talking to the experts. He's been around since you guys were in diapers. Talk to guys like this. Get to know how to beat out those investment funds and how to have the right backing behind you for a mortgage. Because it's only going to get worse. Because otherwise, you guys like to rent, and those hedge funds are going to just continue to ride that horse. You are the horse. You're the rental horse, and I'm going to say it. We'll continue to ride you too, because we love the cash flow. You're just paying us, and you'll never own a thing. We take all the benefits. Don't be that person. I hate to say it because it's my business. I'm trying to bring some value to the world. But you got to talk to guys like Pat Delaney at Union Home Mortgage and learn how to get a mortgage. Get yourself financially literate and go get your own house instead of paying someone else's mortgage. Pay your own. Take the benefits.
And change the narrative. Change the narrative. Get away from just straight interest rate talk. It's important, but it's not as important as A, what you can afford, B, what you want to pay, C, how you make that work, right? I talk to people, I talk to a lot of younger folks who I want to buy a condo. Nothing wrong with condominium. It's a lifestyle, right? Everybody likes not having to cut grass or shovel snow or something. But in a condominium, you pay $300-400 a month in an association fee, right? That is a lot of buying power, right? When you look at it on a monthly basis, a condominium fee is a huge chunk of buying power. That could be the difference between buying, a $200,000 condo or maybe a $275,000 to $280,000 single family home, which by the way, wow, I think appreciates more. And
well, sure, Miami on South Beach, yeah, baby. I'm ready. Let's go. So can you give me some quick, three quick tips from Pat Delaney before we end this in this call, because he's giving you way too much value. If you want more, you got to call him directly. One, if I'm looking at a house from a real estate agent, from a broker, from as a buyer, and I see, I was once told it's X amount of dollars per every 1,000. It's a quick way.
Download my mortgage app.
There you go.
Okay. Download my mortgage app. Punch in your situation. Punch in the purchase price, how much money you want to put down on it. It'll default to an interest rate. I will tell you that on the mortgage app, the interest rate is always going to be higher than the market price. And I'll tell you why. To keep you conservative. Okay.
Checks and balances. Folks.
Checks and balances. We want to make sure that you're not getting yourself into something that you can't afford on a monthly basis. But do the work. Do the work on the finance before you find the house. Right? For two reasons. A, it's a lot of paperwork and you want to be done with it. Two, you could be going out there. I'll give you another one. We talked about Lock and Shop. It's called Ready, Set, Home. It's a great program. I'll give you a mortgage approval before you find a house. Okay. You'll go through
before the house.
You'll go through the mortgage process. You will have your mortgage commitment. So now let's just say you do find the dream house and you go to make an offer. Right now, people are, cash is king, right? The cash offers are always getting looked at, favorably. Well, what's second? If you have, let's say you have 10 offers, 2 are cash, but they're slightly lower. And then there's 8 with financing, right? And of those 8, 7 of them have pre-qualifications. Now, what's a pre-qual? It means you called me, I ran your credit report, you told me you made $100,000, and I go, okay, you're pre-qualified, go get it. Ready, Set, Home, I make you send me your paperwork, your bank statements, your pay stubs, your W-2s. I submit it to an underwriting department. They issue a full-blown commitment to you. Now, when you make your offer, you're submitting that offer subject to an appraisal only. That's it. You're done. Close in 20 days if you want.
So pre-qual, it's a stated application form with a small credit check. Ready, Set, Home program, I'm actually going through an underwriting process.
You're done.
And there is some paperwork, but their team is great. They'll take you through a checklist, a punch list, and make it very simple and streamlined for you. So I'm going to give you my last 3 months bank statements. I'm going to give you a copy of my ID. I'm going to give you whatever letter you need from my student loan stuff, right?
We're going to find out,
And then I'm done. And then at that point, my offer, I can close faster.
All we need is an appraisal.
Or use an appraisal.
So you're 20-day close, you're competing with the cash buyer.
You're competing with the cash buyer.
Yeah. So if you're slightly, you have a stronger,
better offer.
Right.
It looks so much stronger
than a 45-day
on an offer.
Yeah.
It looks so much stronger with the offer that you put forward. You're putting forward a mortgage approval as opposed to a pre-qualification letter.
And you have lock rates, so you can lock them at a lower rate, and you can hang on to that rate for 90 days. And then we have the bond loans. You want to touch on that? State, okay.
New Jersey State Bond Loan, great program. FHA loan, $10,000 grant from the state of New Jersey. So if you have your folks who are good buyers, right, good credit, but perhaps a little bit of a higher qualifying ratio, or perhaps challenged with down payment money, they can go through that. It is a complicated process, right? It's a mortgage loan, just like us. So you apply for a mortgage through Union. We're the only person that has that program, by the way. No other mortgage company has that. That's a joke. A lot of people have it. So anyway, it's a dual process, right? You have to apply for your mortgage. We get you approved. Then we have to send it off to the state of New Jersey. Then the state of New Jersey kicks it around for a little while, and it comes back. So is it a great tool? Yeah, 100%. It's $10,000 that you can use for down payment and closing costs.
Is there a difference in the cost of doing? Because I hear a lot of people say, "I want the $10,000 grant." I'm like, well, time out. Like that $10,000 over the stretch of the life of the loan, if you actually break down the analytics, might cost you a couple bucks more because there's different origination points. There's different PMIs.
Nothing's free.
Nothing's free, right?
There's no free money. But I will say this: that program's gotten a lot more competitive. It's an FHA loan. Okay, so you're going to pay FHA mortgage insurance, the one-time mortgage. With an FHA loan, you pay the 1 3/4% upfront, which they allow you to finance. Right, so right out of the gate, you're almost 2% gone in just mortgage insurance. Plus, you pay 85 basis points in mortgage insurance a month. So it's a very heavy mortgage insurance process. For those who may not know, mortgage insurance covers the lender in the event that you default. It's got nothing to do with protecting your home or your interests. Okay. So it's an FHA transaction, a little bit more paperwork involved. And like I said, it does have to go to the state. So you've got to give yourself 45 days. When you make that offer, you got to give yourself 45 to 60 days, just because the state is very, very particular. Mm-hmm. And that's the only place where that loan can be sold. So it's not like if we make a mistake, we can take it out of one investor and sell it to another one. The state is the only one buying it. So now I will tell you that a long time ago, a couple of years ago, the difference between an FHA rate might have been 4.5% and the bond loan was 5%. So you were getting the free 10 grand. But you were paying an interest rate spread of half a point. I would tell you that spread's gone now. So it is a pretty effective way to come up with some capital if you're a first time home buyer.
Yeah. Anybody have any questions for Pat before we conclude this session?
You said I got 3 things. I'm sorry.
Yeah.
Oh, that's okay. Pat, you mentioned an app. Where can I find your app if I wanted to download it?
It would be at unionyuhm.com/pdelaney
DLANEY.
Correct. I should probably
I'll
have
put
like
the link in the.
I should probably have like a really cool. What do you guys call those?
Or something?
Like a tag name or something. I should probably have it simple like Delaney.com or something.
At Diddy.
At Diddy.
There
Diddy
you go.
Mortgage.
Anyone else have any questions before I give you my
P.
third?
Diddy. P. Diddy
My
stole
third
it
point
from,
that I wanted to
P.
cover
Diddy
with him?
stole it from me.
No? No, we're good?
Yeah.
What is your favorite financial movie?
Oh, Wolf of Wall Street. Wolf of Wall Street is a classic.
Classic.
And by the way, there's a scene in The Wolf of Wall Street. Again, I don't want to make it seem like interest rates are nebulous and like nobody really knows, right? And there are some technical factors. But remember the scene in the beginning where Matthew McConaughey is sitting there with Leo DiCaprio and he's going, you know what a Fugazi is? It's a Fugazi. Nobody really knows what's going to happen, you know? And he goes into the fact what I said. The brokers make money. They don't care if it goes up. They don't care if it goes down. They just make money on the sale. A little bit in the interest rate world, right? I mean, these are mortgage-backed securities. They get bought, they get sold. So they don't really care whether they buy a security at 6, 7, 8, 9, 10. They don't care. They get paid.
Love it. All right, guys. If you have any more follow-up questions,
Thanks for your
please
time,
email
everybody.
Pat. Go on his...
pdelaney@uhm.com. It's very
give him a
simple.
call, 609-405-1567, and pick his brain. He is here to answer some questions, and I appreciate him taking the time today.
You guys are great. Thanks for your time today. Have a great day.
Take care.